Ah, the little green owl. Come on, you know who I'm talking about. You've probably gotten one of its, let's call them persistent notifications. Duolingo is, without a doubt, one of the most recognized apps on the entire planet. And its business, it's absolutely booming. But its stock, well, that is a completely different and frankly, a much more confusing story.
I mean, just look at this chart. It tells such a wild story. At its absolute peak, Duolingo stock was flying high, way up over $540 a share. And then it just came crashing down, all the way to under $100. It's a spectacular collapse, really. The kind of thing you'd expect to see from a company in some kind of deep, deep trouble. But with Duolingo, that's where things start to get really weird.
Because you see, while the stock was in free fall, the actual business itself was just soaring. In its most recent fiscal year, Duolingo grew its revenue by a massive 39%.
So you've got a business that is firing on all cylinders, just crushing it, and at the same time, a stock price that's in a total nosedive. How can both of those things be true? What is actually going on here? Well, that is the puzzle we are going to piece together right now.
Okay, so to really understand this paradox, we have to pop the hood and look at the engine. We need to see just how strong Duolingo's business actually was in 2025. So for a minute, let's just forget about the stock price and really examine what's driving this company.
Let's start with this number: daily active users. The company reported a staggering 52.7 million people were using the app every single day. That's not a monthly number, folks. That's a daily habit. It just shows you how deeply this app is embedded in people's lives. And out of those tens of millions of daily users, a growing number are actually opening up their wallets. The company finished the year with 12.2 million paid subscribers. These are people paying for premium features, like getting rid of the ads.
So you take all those users and all those subscribers, and what does it translate to? A huge milestone. For the first time in the company's history, they brought in over $1 billion in total revenue. And this number, this might be the most impressive of all. The company generated over $360 million in free cash flow. Now, for investors, this is a really crucial number. It shows the company isn't just growing on paper, it's generating a ton of actual, real cash.
So when you pull it all together and look at it like this, the picture is just undeniable, isn't it? We're talking about powerful double-digit growth across every single important metric. More daily users, more paying subscribers, and a lot more revenue. By any normal measure, this is a company with incredible momentum and fantastic health. The secret sauce behind all of this is what they call the freemium model. It's pretty genius, actually. They don't lock up the core learning stuff behind a paywall. Anybody can use it for free, and that attracts hundreds of millions of people. Then, a small fraction of those users, turns out it's about 9%, eventually decide to upgrade to a paid plan. And that small fraction, they fund the entire company. And this model creates these two incredibly powerful self-reinforcing cycles. They call them flywheels. First, you have the learning flywheel. More users means more data, which helps them make the product better, which, you guessed it, attracts even more users. Then there's the investment flywheel. More subscribers means more money, which they pour right back into making the product better, which attracts more subscribers. It's a brilliant engine for growth. Okay, so if the business is a rocket ship, we have to come back to our original question. Why on earth did the stock crash? The answer, it turns out, isn't in those fantastic 2025 results. No, it's in what the company announced it was going to do next. And here it is. This one sentence from the CEO's letter to shareholders is the whole key. He says they are deliberately prioritizing user growth, and then he drops the phrase that must have sent an absolute chill down the spine of Wall Street: moderates near-term financial growth. What the company announced was essentially a major pivot. They're flipping the script. Instead of focusing so hard on turning free users into paying ones, sometimes by adding friction like more ads, the new focus for 2026 is all about making the free experience even better to attract even more users. They're choosing to sacrifice short-term profits to build a bigger foundation for the long game. And right here, in the company's own forecast, you can see exactly why investors panicked. After growing revenue by 39%, their guidance, their prediction for the next year was just 15 to 18%. And bookings, which is basically a measure of future revenue, was projected to slow way down from 33% growth to just 10 to 12%. To the market, it looked like a high-growth company was suddenly slamming on the brakes. But hold on, there is another huge layer to this story, a real wild card that's both a massive opportunity and, well, a massive new cost.
and that is artificial intelligence.
For Duolingo, AI is a classic double-edged sword. On one hand, it's a huge opportunity. It powers incredible new features like Duolingo Max, it lets them personalize lessons, and it helps them create new content way faster. But on the other hand, it's a big risk. It comes with much higher computing costs, it opens the door for new competitors using similar AI tools, and of course, there's always the risk that an AI error could damage their brand.
And this part is absolutely crucial. Going all in on AI is not cheap. The company flat out said they expect this investment to hit their bottom line, pushing their profitability, what's known as gross margins, down from over 72% to around 69%. So for an investor, this looked like a double whammy, slowing growth and lower profits in the near future.
So you combine this big strategic change with the heavy cost of AI, and what do you get? You get a classic dilemma for investors. It creates two very compelling, but completely opposite stories about where this company is headed.
Let's break it down. You've got the bull case. That's the optimistic view. The bulls say this is a brilliant long-term move. They're taking 1 year of pain to build an even bigger user base, widen their lead in AI, and expand into new subjects, creating a dominant global learning platform. Then you've got the bear case. The bears worry the gamble fails, that user growth doesn't pick back up, that AI competitors catch them, and that the company is just left with slower growth and lower profits for good.
And look, this uncertainty isn't just a theory. You can see it perfectly reflected in what the professional analysts are forecasting. Their price targets for the next year are all over the place, from a pessimistic $74 to an optimistic $139. That incredibly wide range tells you everything you need to know. Even the experts are completely divided on which of those two stories is going to win out.
Which leaves us with the one ultimate question at the very heart of this entire story. The business is strong, no doubt about it, but the new strategy is bold and it is risky. So, is Duolingo making a brilliant sacrifice, trading today's profits to absolutely guarantee its dominance tomorrow? Or is it a gamble that's going to end up costing them dearly? For now, only time will tell.